In this video, I'll be discussing project cash flows and how they relate to risk and capital budgeting. Now, to get us started with a quick example, I thought I'd introduce you to the Dubai World Islands, which you can see in this photo. These are man-made islands, and they're being developed off the coast of Dubai by a company called Nakil Properties. Each of these islands is built by dredging sand from the ocean and then building on top of the sand with other materials. Most of these islands have actually already been purchased, and the developer, Nakil Properties, has a goal of selling each of these for a hefty sum. But they've run into some problems. The first problem they've run into is that the developer had to halt production because of the 2008 financial crisis. Many of these islands have sat idle for years. The other issue the developer has been facing since at least 2011 is that because these islands were built partially by dredging sand from the ocean floor, some of the islands have actually been eroding back into the Gulf. The reason I mentioned the Dubai World project is because this is an example of what can happen when capital budgeting goes wrong. No matter what expectations we have about the future cash flows of a project, we always need to be aware of the possibility of cost overruns or events out of our control. Now let's run through what we're going to cover in this section. I'll start off by introducing you to the concept of free cash flows, and then I'll show you how to estimate those free cash flows. Then we'll explore some examples and discuss how some more advanced subjects related to cash flow risk are pertinent to capital budgeting. Finally, I'll end by discussing capital budgeting in an international setting, and I'll discuss some of the risks that must be estimated when dealing with overseas operations. So we've already discussed capital budgeting in the previous section, but I'll define it again. Capital budgeting is the process where firms identify and invest in projects. They analyze different projects the firm could take on, and they determine which project to select based on NPV or other techniques that we talked about in the previous section. Now, the value we often focus on in capital budgeting is referred to as incremental cash flows. From a capital budgeting perspective, these are the only cash flows that matter because they're the relevant cash flows that will accrue to us if we accept the project. We measure incremental cash flows as the difference between the expected cash flow in a period if we accept the project and the expected cash flow if we don't accept the project. Viewing projects as mini firms, so to speak, with their own assets, revenues, and cash flows allows us to evaluate the investments separately from the other activities of the firm. This is referred to as the standalone principle. There are a lot of things that are considered incremental cash flows. First, we have side effects that occur if you accept a project. For example, if you already sell one type of deodorant and you introduce a new type of deodorant to the market, some of your current customers are probably going to switch to the new brand. We need to reflect that loss of sales from the old brand when we estimate our incremental cash flows. Next, we need to consider the changes in the net working capital and fixed assets that come from development of this new project. If you need to buy a new piece of land or new production facilities to produce a good or a capital budgeting project, you need to reflect those costs in your incremental cash flows. Most projects will require an increase in net working capital, or NWC for short, initially because we're building inventory and receivables. New projects often require incremental investments in cash, inventories, and receivables that need to be included in the cash flow for the project if they're not going to be offset by changes in payables. Later, as projects end, the investment will often be recovered. You also need to include any taxes you'll have to pay as a result of accepting the new project. Finally, your incremental cash flows need to reflect the opportunity cost of not taking on another project because you took on this project. There are some other potential cash flows that would not be considered incremental cash flows and thus would not be included in the estimation of the incremental cash flows. The first are sunk costs. Sunk costs are cash flows you've already paid for or you've already accrued. For example, an oil well where you keep drilling but you don't find oil would be an example of a sunk cost. You've already paid for the drilling of the well. Anything you've already paid for, you shouldn't consider in your new analysis whether to continue drilling. You shouldn't factor in the previous capital you're investing in a project when you decide whether to accept a project or continue a project, is what I'm trying to say. Next, we have financing costs. Financing costs are not included in the cash flows of the project. They're impounded percentage-wise into the discount rate. The higher the cost of financing a project, the higher the discount rate we should set. Finally, we have depreciation. Depreciation is a non-cash expense, so we need to make sure we don't include it in our analysis, or if it has been added to our calculations, we need to remove it from our calculations, which we'll do in a bit. Now that I've introduced incremental cash flows to you, it's time to discuss how we actually estimate those cash flows in the real world. What we often do is look at the expected change in a firm's free cash flows. Free cash flows are the cash flows received by the firm, but not needed to pay off debt or costs of goods sold or taxes. Free cash flows are what's left over once we've paid for everything we need to pay for. We call them free cash flows because they're just being added to our cash or being invested. Now, we valued firms using dividends earlier in this lecture series. That works only if the firm is paying out all of its cash flows using dividends. We estimate historical free cash flows by taking information off the firm's financial statements, its balance sheet, and its income statement. To forecast free cash flows, we need to build what are called pro forma financial statements, which are estimates of the future financial statements that the firm will put out. Now let's talk about the free cash flow formula. Free cash flows represent exactly what they sound like, cash flows that the firm is free to do with what it pleases. To start, we take the earnings before interest and taxes from the income statement. Next, we add back depreciation because when the financial statements are built, accountants subtract depreciation as a non-cash expense in order to arrive at the earnings before interest and taxes. To adjust our cash flows to remove the effect of this non-cash expense of depreciation, we add it back into the equation. Next, we need to estimate the taxes the firm will pay. Finally, we subtract the changes in both capital expenditure and net working capital over the period. There are many formulas for free cash flows. The one I have at the bottom is another example. This one subtracts taxes from the formula by assuming a tax rate rather than forcing us to know the actual amount of taxes being paid. Now, I do have a couple final points to make when estimating free cash flows. First, EBIT, or earnings before interest and taxes, is sometimes referred to as net operating income on the income statement. Second, if we're calculating the NPV in the real world, we're going to be estimating the difference from the baseline that occurs when we add the project, so all of these numbers are actually going to be changes from the baseline. You'll see this later in a much more complete example. Now, I mentioned pro forma financial statements a few seconds ago. Let's talk about them in a little more detail. Pro forma financial statements are just estimates of a firm's future financial statements. We often want to estimate pro forma balance sheets and pro forma income statements. Usually, we want to try and estimate these out about 3 to 5 years, but any further estimation is probably not going to be that accurate. All right, so let's take a look at an example of pro forma financial statements. To do that, I'm going to click on the link that I've provided, and I'll provide this link in the comment section. So this link will take you to an example of Facebook's unaudited pro forma financial statements around the time that it acquired WhatsApp. So this data, or these pro forma financial statements, are provided on the SEC's data repository website called EDGAR. It's literally, if you just type in EDGAR in Google, it'll be edgar.gov, and you can find your way to this page if you want to. But these financial statements were put together when Facebook had just purchased WhatsApp, and they had put together an estimation of the combined firm's balance sheet, which you can see here. So here's Facebook's historical balance sheet, here's WhatsApp's historical balance sheet, here's the adjustments that were being made based on the merger, and then over here we have the pro forma combined balance sheet. This would be Facebook's best assumption of their balance sheet, assuming the effects of what's called synergy, which is essentially the benefits of a merger. Now, if we go down here, we can see their pro forma income statement as well. So Facebook's historical income statement, WhatsApp's historical income statement, some adjustments, and then the pro forma combined statement. This is their best projection as to their income statement as of this point in time. All right, let's go back to the slides. Now let's talk about how we estimate the change in capital expenditure, or what you see up there is that delta CapEx, or that triangle CapEx. That's the symbol for the change in capital expenditure. And we'll also talk about how to calculate the change in net working capital, or that delta NWC, which is typically how we refer to it in a formula. So delta always stands for change, and NWC always stands for net working capital in finance. Now, the change in CapEx, or the change in capital expenditure, refers to the change in property, plant, and equipment in the firm. When we invest in a new project, we often need to purchase these fixed assets, and we have to be able to buy the assets before we can generate the sales. We can calculate the change in CapEx by getting the gross PPE, the gross property, plant, and equipment, off the balance sheet during the current year and subtracting the gross PPE from the previous year's balance sheet. Gross PPE is the total spent on the property, plant, and equipment for the firm without considering the non-cash expense of depreciation. Next, we need to estimate the change in net working capital, or delta NWC. Net working capital refers to all of a firm's short-term accounts. So current assets would include cash, inventory, and accounts receivable. Accounts receivable are just sales that have been recorded but not received, and current liabilities include accounts payable and short-term notes. Accounts payable are purchases that are owed to suppliers but have not been paid. By looking at changes in net working capital, we can incorporate the increased investment in receivables and inventory that are necessary to support the additional sales. Because we look at changes in net working capital and not just current assets, we also incorporate the increase in our payables account that partially pays for the inventory, or the investment in inventory and receivables. Accounts receivable and inventory increase to support the higher sales level that we expect if we accept a capital budgeting project. Accounts payable also tends to increase to support the higher inventory levels. Now let's talk about depreciation. Depreciation is, as I said earlier, a non-cash expense. However, depreciation affects taxes, which are a cash flow. The relevant depreciation expense is the depreciation that will be claimed for tax purposes. Consequently, we need to understand how the IRS requires depreciation to be computed. The depreciation amount for an item depends on the depreciation schedule we use. A description of the depreciation schedules used in the US can be found by clicking the link that I have provided on our slides. I'll put the link in the comment section of this video as well. When depreciation is recorded for a capital asset like a company car or a piece of equipment, that depreciation expense is included in the income statement as an expense, and it's used to decrease the earnings before interest and taxes. The reason this is important is because we want to know how much cash the firm actually generated during the period. If we're subtracting depreciation from our sales revenue to get our earnings before interest and taxes, we need to add that depreciation back into the equation for our free cash flows. This is why we add depreciation in this formula that I've given you. There are many different ways to depreciate assets. Two of the most common are straight-line depreciation and the Macker's depreciation. Straight-line depreciation means that we calculate the periodic depreciation expense by taking the initial cost or price of an asset, like a car, estimating the salvage value, and then dividing by the number of years that we're depreciating the asset for. The number of years is set by the IRS. The straight-line depreciation method will give us the same amount of depreciation each year until the asset is equal to the salvage value. The Macker's, or Modified Accelerated Cost Recovery System, depreciation schedules are a bit more complicated. There are different Macker's depreciation schedules depending on which asset you're depreciating. For the full list, see the link I've provided in this description of our video. It's also listed here on our video, as you can see. We depreciate assets by removing a certain percentage of the initial cost of the asset each year. The depreciation expense is the initial cost multiplied by the percentage assigned by the IRS for that year. Let's take a look at an example of Macker's depreciation. All right, in this example, your firm purchases a truck for $45,000, and trucks, according to the IRS, have a 5-year depreciation schedule. So the value of that truck is going to fall because it's depreciating over 5 years, at which point that truck will be worth whatever the salvage value is expected to be. And let's assume that our marginal tax rate is 35%. Now, to calculate the amount of depreciation that you're going to record on the income statement and then add back in to calculate your free cash flows, we're going to start off by saying that our beginning value is $45,000, that was given. And what we have here in this third column is our MACR's depreciation for vehicles. This is the amount of depreciation that you record for vehicles in a 5-year depreciation schedule. And I know I say 5 years, but the IRS actually, when they say 5 years, it's a 6-year depreciation schedule. And if they say 7-year depreciation schedule, it's actually an 8-year depreciation schedule. It's a bit weird. But anyway, this depreciation percentage represents the percentage of the vehicle's value that disappears over the course of this year. So if we start off with a beginning value of this truck of $45,000, at the end of this year, 20% of that value is going to disappear. In other words, it's going to be eaten up in depreciation expense. So at the end of the year, this truck is only going to be worth $36,000. And that $9,000, which is $45,000 times the 20% depreciation, that's our depreciation expense. We would include it in the income statement, and then if we're calculating our free cash flows, we're going to add this number into our free cash flows formula. Now, these percentages are set by the IRS. So in year 2, we're recording a 32% amount of depreciation. So the total value, the depreciation of this truck is going to be our beginning value, which was the book value of this asset last year. So $36,000 times 32%. And our depreciation expense is going to be $14,400, and our remaining value is $21,600. And this is going to repeat itself until we get to a book value of 0. At the end of this project, all fixed assets are sold for their salvage value. If the selling price, or that salvage value, is greater than the asset's book value, which remember in this previous example was 0 if we use MACRs, then the tax is owed on the gain. Conversely, if an asset is sold for less than the book value, which in this case is really impossible, then you're going to be able to recover tax on that asset. Now, this means that if you're using the MACR's depreciation, you'll likely always owe taxes on the salvage value, since you're depreciating the value of the asset down to a book value of 0. Now, let's take a look at how the same example would be worked if we sold that truck at the end of year 2 for $25,000. So same example, we start off with a value of $45,000 for this truck, and we have our MACR's depreciation schedule over 5 years. So I've only included the first 3 years of the schedule here. If you want to see the remaining 3 years, go back a little bit in the video. Now, the way we actually calculate depreciation is exactly the same. So we have that $9,000 depreciation expense in year 1, $14,400 in year 2, and in this example, we're selling the truck for $25,000 at the end of year 2. Well, at the end of year 2, the book value or end value of this truck that would be recorded on our balance sheet would be $21,600. However, if we're selling this truck for $25,000, we're going to have to pay tax on that truck because that $25,000 is more than our book value, our $21,600. The tax we're going to pay on that is going to be, well, whatever the difference between our selling price is, $25,000, and our book value is. And we're going to multiply that by our marginal tax rate of 35%. In this case, we're actually going to have to pay about $1,190 in taxes, because that's this difference between salvage value and book value times our 35% tax rate. Our after-tax salvage is just going to be our $25,000 minus whatever the taxes we're paying to federal government. Now it's time to look at a more complicated example. To do this, I'm going to give you the information in the slides, and then we'll move that information over into Excel and estimate the net present value of the project. This example will require us to put together everything we just discussed. So I'll go through this and on the slides, and then I'll move to Excel. So you're considering starting a restaurant which will provide you $500 in revenue every year for the next 4 years. You expect operating costs of $200 every year. Obviously, this is not a realistic example. And you must buy $200 worth of equipment which depreciates over 4 years using straight-line depreciation. You pay for this equipment now. Your working capital is 10% of sales every year. The tax rate is 33.33%. Your required return is 15%. Use the free cash flow formula and calculate the net present value of this investment. All right, so pretty detailed word problem, and we have a lot of information here that we need to pull out. So let's see what we have. Well, we know that we're going to have sales revenue of $500 in years 1 through 4. So these are 1 year from now through 4 years from now. We also know that we're going to have operating costs of $200 every year. That was given in the problem. And you have an upfront equipment cost of $200. So this is probably going to be our PPE or change in PPE. And our equipment depreciates over 4 years, straight line. So every year we're going to have the same amount of depreciation all the way until that equipment becomes worth whatever the salvage value is. And our working capital is 10% of sales. We'll use that in a second. Basically, we're just going to use that 10% and multiply it by sales to get our working capital, and then look at if that changed over the period or from year to year. Tax rate, 33.33%. We'll find a use for that. And then we're going to assume our required return on projects of this risk level is 15%. So this appears to be a very risky project, which obviously most restaurants are. So this is probably a pretty appropriate return. Well, it's probably more appropriate than, say, a 5% required return. All right, so now I'm going to jump over to Excel, and ahead of this, I've put together all of the data in a model. So what I have here is more or less all of the components that we just mentioned, and I have the exact amount that we're earning or the amount that those components are going to cost us in year 1 from now, 2 years from now, 3 years from now, 4 years from now. So like I said, sales revenue is $500 from years 1 through 4, operating costs $200 in years 2 through 4, or 1 through 4, sorry. Our EBIT is just the difference between our sales revenue and operating costs. Our taxes are going to be 33% of our EBIT, so I'm just multiplying our EBIT by 33% to get our tax expense. And our net operating profit after tax is just going to be the difference there. Now, that net operating profit after taxes, we can either use this or the EBIT to calculate our free cash flows. I'm going to go ahead and use net operating profit after taxes and then add in our depreciation, our change in net working capital, and our change in capital expenditure. So here's our NOPAT, our net operating profit after taxes. This is what we're after. It's essentially EBIT times 1 minus the tax rate, which you saw earlier. Our depreciation expense is going to be calculated as, well, we'll go back to the problem and pull that out. So that equipment is worth $200 and it's depreciating over 4 years. And since I don't have a salvage value here, we're going to assume that the salvage value is 0. In other words, at the end of 4 years, this thing is worthless. Whatever equipment we have, we're not going to be able to sell it for anything. Anything that we could sell it for would just cover our scrapping costs, our hauling expenses. So the way we calculate our depreciation expense is just by taking our initial cost, subtracting our salvage value of 0, that'll give us 200, and dividing by our 4 years that we're depreciating for. In other words, this depreciation expense would be 200 minus 0 divided by 4, or as I have here, $50. Now let's talk about our change in net working capital. Now, if you remember, our change in net working capital, or our net working capital, is always going to be 10% of our sales every year. This is just a rough estimate, and so if we go from having 0 sales in year 0 to 500, our change in net working capital is just going to be 500 times 10%. Now, because we don't have any change in our revenue, that means that our change in net working capital is going to be 0 until the very end when we can recoup our change in net working capital. So at the very end, we have our sales revenue, and year 5, we're theoretically not going to have any sales revenue. So I decrease this by 50. Finally, we have our change in our capital expenditure, or this could be change in PPE or change in CapEx, however you want to list it. Now, this was actually given in the problem. You must buy $200 worth of equipment. So I recorded that as $200 as of year 0, aka today. Now, our free cash flow is just going to be our net operating profit after taxes, adding in depreciation, subtracting out the change in net working capital, and subtracting out the change in our CapEx, or delta CapEx and delta net working capital would be this purple. So once we've summed up all of these free cash flows for each year that we're investing in this project, and we have our required return, we can estimate our NPV and our IRR. To do that, we're going to use the NPV formula in Excel. So we know that our required return is 15%. That's going to be the rate that we use. And when you use the NPV formula in Excel, you always highlight the future cash flows because Excel is starting out with year 1 or year T+1. In other words, the first cash flow that you have here is already going to be discounted, assuming that it's 1 year from now. So we're going to use these cash flows from year 1 to year 4, and then we're going to add in our free cash flow in year 0. And that'll give us our NPV of this project. So $498.86. So obviously, this project is good. It adds value to us as a shareholder or the owner of the company. If we want to get the IRR, all we have to do is use the IRR function in Excel and then highlight our stream of cash flows. And this will give us a rate of return, our internal rate of return, which, given that we're starting out investing $200, this is a pretty good rate of return. So if I was looking at this project and I had no other projects to invest in, I would say, yes, invest. All right, so let's go back to our material for today. Now let's talk about measures of risk. We've already discussed what you see here, but let's discuss them in a capital budgeting context. In the previous video, I introduced the concept of the required rate of return, or the discount rate we use to discount future expected cash flows. It's time we talk about how we calculate that. Let's start with the primary measure of a firm's market risk. It's beta. A stock's beta tells us how much market risk a particular stock faces. The higher the beta, the more market or systematic risk is present in that security. A beta of 1 tells us that the firm has just as much market risk as the market as a whole, aka the S&P 500 index as a whole. The reason I'm mentioning the beta again is because many people use the beta to estimate our required rate of return. Sometimes we use what's called the pure play strategy and assume a project has just as much risk as a stock in the same industry. For example, if we're considering accepting a project that involves opening a new restaurant or a set of restaurants in a new area, we might use the beta of similar restaurants to determine the required rate of return we should use. Sometimes we'll take the firm's required rate of return or discount rate that we just calculated using the CAPM and adjust it upward or downward if we feel that the project is either riskier or less risky than the firm's projects on average. This will give us what's called a risk-adjusted discount rate. Now, hopefully you remember this formula, the CAPM formula, the capital asset pricing formula. This is the most common formula we use to calculate the required rate of return. We estimate the project's beta, and then we determine the risk-free rate and the excess return on the market, which is the difference between the expected return on the market and the risk-free rate. Let's look at an example. So in this example that we have below, the yield on a 10-year T-note is 4.25%, and the beta of firms that take on these projects or these types of projects that we have in our company is 1.15. So in other words, the beta of the firms that are taking on projects that we're considering, or that only operate or conduct projects that we're considering, these firms are slightly more risky than the average in the market. Now, the market risk premium is assumed to be 6%. If we want to calculate a project's required rate of return, all we have to do is use the CAPM formula. So here, our risk-free rate is always a yield on a treasury, and we have the 10-year T-note, and that's 4.25%. And we're adding to that the beta that we're given, or that we would assume would proxy for the market risk here, which is 1.15. And the excess return on the market is assumed to be 6%, aka the market risk premium. So market risk premium and excess return on the market, they're synonymous. So all we're doing to calculate the required rate of return for a particular project is we're taking beta times the excess return on the market, aka market premium, and adding to that the risk-free rate. And we get a required rate of return in this example of 11.15%. Now let's talk about the accuracy of forecasting techniques we frequently use and have been discussing in this section and the previous section. There's a wide range of accuracy with regard to forecasting techniques depending on the type of project you're estimating the cash flows for, as well as the market conditions, the stage of the market, and the industry in which your firm is operating. However, let's talk about what we can say with certainty based on academic research. First, we know that free cash flow estimates are almost never accurate. An analyst may base his estimates on incomplete information, or there may be unforeseen circumstances that lead to increases or decreases in the future cash flows. We also know that our discount rate, aka our required rate of return, is also not very precise in some cases. For many projects, there's an inherent amount of risk since the cash flows will not always be exact. The more forecasting risk we have, the more important methods for controlling this risk become. Now let's talk about the tests we frequently use to reduce the impact of inaccuracies in our free cash flow and discount rate forecasts. I've already mentioned in the previous section that it's important to use multiple projects before you select the projects you as a manager are going to accept. Methods like IRR or the payback method should always be used in conjunction with your NPV estimate. We can also use scenario and sensitivity analysis to analyze what happens when the assumptions upon which we've built our forecasting model change. If we want to get very fancy, we can even use a technique called Monte Carlo simulation that will allow us to see what happens if we simulate the results of our project based on a set number of inputs. Finally, if we want to be very cautious, we can also select projects that will offer our firm what are called real options, or sometimes we refer to them a little more completely as real managerial options. These options will allow us to scale up the project if conditions are deemed appropriate, or scale down the project if we determine that conditions are not deemed to be appropriate. Let's talk about scenario analysis first. Scenario analysis involves us putting together at least 3 different scenarios, one where conditions are good, one where they're neutral, and one where there are some adverse consequences. We often will adjust all the possible variables based on a particular scenario and report the NPV or IRR based on the change in those assumptions. Theoretically, we can have dozens of different variables in the scenario. There are some big drawbacks to scenario analysis. The first is that unless you have a lot of time and patience, you're likely only going to put together 3 or 4 different scenarios that are accurate. The second big drawback with scenario analysis is that when most people perform scenario analysis, they assume a lot of the input variables are positively correlated. In other words, if we're putting together a worst-case scenario, we might assume that both sales revenue is low and cost of goods sold are high. In the real world, not everything will be bad all at once, nor will everything be good all at once. What will likely come to pass will be somewhere in the middle, so it's best to use other methods beyond simple scenario analysis when analyzing projects. Let's take a look at a quick example where scenario analysis has undoubtedly been used. A movie costs $250 million to produce, has a 3-year life, with various depreciation methods for each tangible asset. The NPV for each scenario is negative 50 million in the worst case scenario, meaning that our movie has bombed. Our base case, where the movie actually reaps a profit of 300 million, and the best case scenario, where the movie actually does, let's say, a profit of 750 million. And just for the heck of it, let's call this Batman v Superman. So in this case, I think this movie did actually turn a profit, but it didn't do nearly as well as what the producers of the movie actually expected. So this is an example of what we can do with scenario analysis. Our goal is to get an NPV or an IRR. So I tend to focus on NPV because that actually tells us how valuable a particular project will be. The drawback here is, I mean, if we're trying to estimate the profit a movie is going to generate, like I said a few seconds ago, obviously it's very unlikely that we're going to actually hit negative 50 million exactly, or positive 750 million in total profit. I mean, it's unrealistic to assume that would happen. It's very unlikely. All right. When we use scenario analysis or many other tools in finance, we occasionally want to compute a standardized measure of risk. One of the tools we can use is called the coefficient of variation. The coefficient of variation is a standard deviation scaled by a mean. In the case of scenario analysis, what we can do to determine the total risk of a potential project is create the scenarios we think are most likely, like in the previous example, and then calculate the standard deviations of the NPVs resulting from those scenarios, and finally, divide that standard deviation by the expected NPV, which is the mean NPV of the scenarios. The higher the coefficient of variation, the riskier the project is. The lower it is, the less risky the project is. So we obviously want a low coefficient of variation. So in the previous example, where we had, let's say, 3 NPVs, a worst case, base case, and best case, what we would do is we'd take these negative 50, 300, and 350, calculate the standard deviation resulting from these 3 outcomes, and then divide by whatever our expected value or expected profit from this movie is going to be, and that would give us our coefficient of variation. We want that to be very low if we're deciding between one project or another. The next tool we have is sensitivity analysis. In sensitivity analysis, we adjust the inputs and determine the impact a change in one of those inputs will have on the project's NPV. All we're doing is building a model and then adjusting one input and looking at the total change in the NPV. There are several benefits to sensitivity analysis. First, it identifies the variables that will cause the most variation in the project's cash flows. Second, it will allow us to know what inputs we need for the projects to break even. In other words, what revenue growth rate do we need to see an NPV of 0? The main drawback of sensitivity analysis is that we often don't know the likelihood of a change in a variable occurring, so it makes it difficult for us to know the likelihood of that resulting NPV. Let's take a look at an example where we adjust one input and see how it'll affect the outcome of a project. So to do this, I'm going to jump over to Excel again and show you an example that I came up with. All right, so in this example, we have a base case and a case where we actually adjust one of the inputs. So what you're looking at is a very basic 2-stage discounted cash flows model where we have a set of inputs. So this model represents the expected enterprise value of a firm, and we assume that that firm initially, in the base case, will have revenue growth of 8%, cost of goods sold representing 53% of total sales, SG&A expense, so sales, general, and administrative expenses of 19%, and a couple of other base case growth rates and tax rates. So what I've gone ahead and done is I've forecasted that our revenue will grow by whatever our revenue growth is over years 1 through year 6. So these are all pro forma financial statements, or essentially I'm building pro forma sales revenue. Basically, I'm building pro forma income statement, and I guess I could build a pro forma balance sheet, but that's really not necessary here. But what we're doing is we are essentially taking some inputs like cost of goods sold represents 53% of our revenue in each year, and we're estimating our EBIT, our taxes, which are just, well, as I've listed up here, 39% of whatever our EBIT is, and that'll give us our net operating profit after taxes, to which we can add our depreciation, subtract our change in capital expenditures, and subtract our increase in net working capital, and that'll actually give us our free cash flows. So our end result here is that we can actually calculate the enterprise value of this firm based on this pro forma information, these inputs. The end result being our enterprise value of, well, we'll say this is 16,834. So this is our base case. Now, I mentioned that I was using this example to give you a very cursory introduction to how sensitivity analysis works. So let's go to the case where we actually see an increase or a decrease in the cost of goods sold percentage. And I've put together that. And obviously you will have access to the spreadsheet on our Canvas site. So go ahead and check it out. So here, everything is exactly the same, except for one variable. So revenue growth, I just set this the same as the previous tab, SG&A, same, net working capital, tax rate, everything is the same here, except for our cost of goods sold percentage. In other words, let's assume that after adding some new capital equipment, our cost of goods sold, the cost to produce our goods, decreases by 0.5 percentage point. If we want to know how that's going to affect our enterprise value of our firm, what we can do is, now that we've built this model, we can actually adjust our enterprise value to reflect that. I'll put enterprise value over here. And so if I go back to our base case, which was 53%, you can see that our enterprise value changes from 17,523 back to what it was in the base case, 16,834. So if we ever want to plot the impact of a change in the cost of goods sold percentage and its effect on, let's say, the value of a firm, we can actually put together something like this over here on the right-hand side. So what we have is our cost of goods sold percentage, and we have our enterprise value for various levels of cost of goods sold percentage. So as you can see, as we increase our percentage of cost of goods sold, so in other words, what you see as we go lower here, or to lower and lower rows, it becomes more and more expensive to produce dollars worth of revenue. So as you can see, as we increase that cost of goods sold percentage, our enterprise value falls from 23,000 all the way down to 17,000 if we have 52.50. So now, if we want to get fancy, we can actually put together a chart that actually shows this. And that's exactly what I've gone ahead and done. So I've just plotted our enterprise value on the y-axis and our cost of goods sold divided by sales on the x-axis. And as you can see, as our cost of goods sold increases, our enterprise value decreases. So this is one of the ways that you can use sensitivity analysis to actually examine how an input will affect a company or project. So feel free to make use of it. Now let's talk about Monte Carlo simulation. Monte Carlo simulation involves an analyst setting a probability distribution for the value of every variable. So those things in yellow that I just showed you a few seconds ago up here, these are our variables that we're adjusting in our model, things I have highlighted. Now, we can set a probability distribution for each one of those input variables and assume a correlation between each of those variables. If we wanted to, we can randomly generate a number for each of those variables based on the probability distribution and the correlation matrix that we've come up with. And then we can actually do this a large number of times. We can actually simulate data for each of those inputs, let's say 10,000 times. What results is a plot of the likelihood of, say, the NPV or let's say the enterprise value of a firm. So this is what's called Monte Carlo simulation. You're essentially building probability distributions for input variables, assuming a correlation matrix between those variables, building a model, and then randomly generating data for your input variables, and then looking at how the output variable changes when you, let's say, run 10,000 or 100,000 simulations. Let's take a look at a Monte Carlo simulation I created a couple of years ago for my own amusement. So in this Monte Carlo simulation, I wanted to look at or try to forecast the return of Google stock in year 2016. So what I went ahead and did was I built a two-stage discounted cash flows model, kind of like what you saw earlier or a few seconds ago, and I adjusted some of the inputs into the valuation model, so things like revenue growth, etc. And I calculated the difference between the intrinsic value of Google stock and the market value of Google stock currently. And so the end result is that I actually calculated, well, I guess we haven't talked about target share prices here, but in other words, I calculated the difference between what Google stock should be worth in 1 year and what it is currently worth, or was currently worth, the market price, in other words. And so that difference would be our return on Google stock. And so I use this Monte Carlo simulation to build a two-stage discounted cash flows model and predict the enterprise value and the intrinsic price per share, and then eventually the target price of that Google stock. And what you're seeing is the result. So I simulated a large number of times, a large number of outcomes, and this is what you get. Now, Monte Carlo simulation is a popular tool outside of finance. If you're, let's say, a sports fan or a gambler, you've probably heard announcers mention that some analyst ran simulations to determine the outcome of a game or a race. Monte Carlo simulation is often what they're referring to. We can often use real options if we're worried about the riskiness of a project. We use the term or the phrase real options when we invest in projects that will allow us to expand the project if it goes well or contract it if it's not going well. An example of a real managerial option might be if we begin selling our product in a few stores in the state of Washington, and let's say we want to know how the project is doing before we actually expand that project or expand our product offerings to additional stores. If no one in Washington will buy our product, we can always stop selling in the state of Washington. However, if we see good sales revenue or sales revenue that we deem acceptable, we might start selling in more stores in Washington or even expand into, let's say, Oregon or California or Idaho. There are many real options that managers make use of. If a manager needs to contract their operations because they're managing, let's say, a Kmart, and fewer people are shopping at that Kmart, the manager might find ways to shrink the sales space in order to ensure they need fewer sales associates answering questions and working in each department restocking items. So that's an example of how we can actually use real options. All right, the final topic I need to mention is multinational capital budgeting. And multinational capital budgeting is really just capital budgeting overseas or in a foreign country. And really there are a couple of big differences here. The first is a lot of times when you're dealing with capital budgeting overseas, it might be difficult to repatriate any earnings or any cash that you've earned overseas. So there's a couple of reasons for this. First, many countries, for example, China or, name a country in the third world, basically. A lot of countries have what are called capital controls, meaning that you can only take so much out of the country in a period of time. Let's say a day, a week, a year, etc. So in the country of China, you might only be able to, let's say if you're a citizen, take out of the country about $300 a day once you convert their currency, the yuan, into cash or dollars. So that's one of the big issues with multinational capital budgeting. It might be difficult to repatriate earnings you have overseas from your business to the United States. Another issue with repatriation of earnings that a lot of multinationals face is that there's often a tax on earnings that are coming from, let's say, outside the US. So a company like Apple or Walmart or some other large multinational, these companies often face issues when they try to repatriate profit, because the United States actually has a fairly significant tax on foreign profits that are being repatriated. So what ends up happening is that most of that income earned overseas will actually remain overseas, because if it gets repatriated to the US, there's a fairly high tax rate on that income when it's recorded. The next issue we have with multinational capital budgeting is the exchange rate, or exchange rate risk. So let's say you have invested a certain amount of money in operations in India, or better yet, we'll say Japan. And the exchange rate when you invested in Japanese operations, or your company invested in Japanese operations, was 100 yen for every dollar. So essentially you have to convert your $1 or however many dollars you have into a certain number of yen, basically multiply by 100. Now, during the investment period, oftentimes that exchange rate between the yen and the dollar is going to change. So what ends up happening is that when you repatriate that cash, that income that you've earned, or those free cash flows that you've earned in the Japanese market back into dollars, a lot of times what will have resulted is the exchange rate will have moved unfavorably to you. In other words, each yen might not buy as many dollars. In other words, in this example, let's say by the time you're ready to repatriate that cash, now the exchange rate is 200 yen per dollar. So when you repatriate that cash, it'll take you 200 yen to buy a dollar, whereas when you invested that cash, it only took 100 yen to buy that dollar. In other words, your money or your cash flows are now worth half of what they were once they're converted back into US dollars. Exchange rate risk is one of the biggest risks we face in multinational capital budgeting. The final risk we face is what's generally referred to as political risk. And political risk is really just the risk associated with laws or regulations in the country that you're operating in changing during the investment period. And there's all kinds of examples of this. Let's say during the period where you're investing in some operations overseas, the country that you're investing in or where you're operating bans whatever activity that you're engaging in. Or a more nasty example might be if the country that you're operating in, let's say it's the country of Venezuela, decides to nationalize the assets of your company. Nationalization often refers to this idea where a country will take over the fixed assets or the production facilities of a particular company. They'll essentially come in, take over those assets, let's say a production facility like an auto factory or an oil well, and now your company does not own that oil well anymore. And there is some recourse for companies that do face nationalization in U.S. federal court. In fact, that example I just gave with Venezuela, that's currently playing out in U.S. federal court right now. But political risk is a real risk when you're operating internationally. So I just thought I'd mention that. All right, now let's summarize what we covered in this section. We discussed how to calculate cash flows associated with various projects. We also discussed some of the pitfalls to avoid when estimating those free cash flows. For example, we explained why you need to add depreciation back into the free cash flow formula. Finally, we discussed the tools and techniques that are often used to compensate for the riskiness of cash flows, such as sensitivity and scenario analysis, Monte Carlo simulation, adjustment of the discount rate upward or downward, and the use of additional capital budgeting tools like the payback method. If you have any questions about the material for this lecture, please don't hesitate to email me or call me. I'm also available during office hours. I hope to hear from you.